Hello to everyone joining. We'll just give it a minute to allow people to come in, and then we'll start shortly. All right, great. I think we've got critical mass. So let's kick this off. Good morning and good afternoon to all our listeners, depending on where you're tuning in from. I'm really pleased to kick off this webinar. 2022 US crude in a sweet spot. We've partnered with Argus Media today to discuss and develop insights into the US crude market, as well as its freight counterpart. So where they stand today and what it's looking like for the rest of the year. Now, throughout this webinar, you'll see a combination of Vortexa energy and shipping analytics data, as well as Argus Media's pricing data and market expertise. Before we start, a few details and housekeeping rules. As you'll see, there's a chat and Q&A section, so feel free to ask your questions in there throughout the webinar. At the end, we'll try and answer as many as we can. For those we aren't able to answer, we'll aim to reply after the webinar. Everyone will get a copy of the slides, as well as a recording of the webinar afterwards. I think we'll be presenting for about 30 minutes. The total webinar should last 45 minutes. So that will leave some time at the end for questions and answers. On the following slide as well, when we introduce ourselves, there'll be emails there if you wish to reach out. All right, well, without further ado, let me introduce myself. My name is Arthur, and I'm the lead freight analyst here at Vortexa, so in charge of our freight analysis coverage.
I'm Amanda Hilo. I'm the deputy editor of the America's Crude team at Argus, and I focus on U.S. waterborne crude and oil exports.
And my name is Nicholas Watt. I'm the America's Freight editor, and I work out of the New York office.
Yes, and I'm Jay Pruitt. I do the business development for our forward curve products, and I am out of the Houston office.
Thank you so much, all. So today for our agenda, we'll go over three parts. The first one, we'll start by looking at crude and exports specifically out of the US. Part two, we'll look at what that has meant and will mean for freight market dynamics. And then last but not least, we'll talk about Argus forward curves and how that can help inform a view of the market going forward. So why is US crude such a hot topic? Well, we'll start by diving into that first. Now, it's easy to forget that barely 10 years ago, US crude exports, actually US crude production, hovered at about 5 million barrels per day. Since in 2019, we actually reached 12.5 million barrels per day, even though it has dropped off slightly because of the impact of the pandemic. The US is truly a balancing factor in the market. Whenever marginal barrels are needed, it's usually to the US that the market will turn to. And this is really something key to keep in mind for this presentation today, especially given the current circumstances and the supply tightness that the market finds itself in. So on the left-hand side, you'll see a chart here of US crude exports by vessel class. What's really evident is that continued growth since September. It's close to doubled. Has jumped about 35% since then. And the data for February only reflects the first 15 days. So you're not seeing a drop there. It's interesting to split it by vessel class because you can see here the VLCCs are the ones that have driven this growth and this increase in ton miles. And that's really, what that really means is the increase in long haul voyages to the other side of the globe. Whereas Suezmax, Aframax tankers, they tend to deliver their barrels in Europe, so more of a transatlantic trade. On the right-hand side, you'll see US crude exports by grade, and it's no surprise that light sweet composes the majority of these exports. I'm now going to hand over to Amanda so we can see what lies in store for the future of US crude production.
Thanks, Arthur. So we expect that U.S. crude exports are going to continue to grow near term. We are expecting them to hit a record high on an annual basis, somewhere between 3.2 to 3.5 million barrels per day this year, as both supply and demand continue to recover from the earlier stages of the COVID-19 pandemic. If you look at supply alone, analysts are predicting that U.S. crude production is going to increase to 11.97 million barrels per day this year, and then rise a further 630,000 barrels per day in 2023 to 12.6 million barrels per day. So that'll be a new all-time high, surpassing pre-pandemic levels. Now, in the Permian Basin alone, we're expecting it to reach a record high this month of 5.1 million barrels per day, and then a further 5.21 million barrels per day in March, according to the latest stats by the EIA. And then at the same time, as you can see on the right-hand side of your screen, OPEC production hikes have consistently been lagging behind demand, while producers participating in the group's restraint deal have failed to fully deliver each month's higher targets. So, for example, last month, OPEC countries raised output by just 260,000 barrels per day. That brought their full production rate to 37.94 million barrels per day, and that's an 800,000 barrel per day gap compared to the group's overall target for the month. So the largest challenge that we see for growth in U.S. crude exports for the near to midterm could be the revival of the 2015 nuclear deal with Iran, and that could quickly reintroduce around 1.6 million barrels per day of Iranian supply to the global market if sanctions are lifted in full.
Thank you, Amanda. So 1.6 million barrels per day is quite the amount, especially in the sort of tight supply market that we find ourselves in today. So it's important to see whether Iran actually has that extra capacity. And what we're seeing from our data is, if you look at the chart on the left-hand side, Iranian exports have been continuously increasing. Since a low in July 2021, they're actually up by close to 90%, so have more than doubled. And they reach 1.4 million barrels per day in December. So there may not actually be that much upside left. What's interesting to see here, by splitting it again by vessel class, is the increasing share of the use of Aframax tankers. So that's really to continue to make these transactions really opaque, to use Aframaxes to take that crude to STS zones around Malaysia, and then also transfer them on other Aframaxes to do that final leg. But it's not just that. We can see the volumes on VLCCs sort of slowly but steadily increasing as well. So that appetite has grown. In terms of where that crude and those condensates end up, it's no surprise that the majority ends in China, discharges in China. So our data shows that approximately 90% of these cargoes are discharged in China, with about 10% left for Syria and Venezuela as of February 2022. Now, if we take a step back and focus on the big picture, let's see what that means for supply and how much supply is really available.
Yeah, I think that it's really important to note that despite the premature Iranian crude exports and condensate exports, despite rising U.S. crude production and slow but steady growth in OPEC plus production, global markets are still on track to potentially enter a deficit early this year as global crude demand continues to increase compared to the earlier stages of the COVID-19 pandemic. We're also seeing gas to fuel switching in Europe, and we are seeing easing travel restrictions as fears over the COVID-19 Omicron variant kind of fade into the background. So if you look at the total picture, demand is actually on pace to hit pre-pandemic levels pretty soon, and we expect that it'll surpass the 2019 baseline level as early as March. We're additionally seeing escalating tensions between Russia and Ukraine, and that increases the possibility of US sanctions being imposed on Russian exports. And that could be an additional 4 million barrels per day of supply taken out of the market if that ends up happening. So theoretically, that could tip the balance into a deficit sooner rather than later. But ultimately, it does increase the call on US crude exports. Next slide, please. And the US is prepared to meet this challenge. The infrastructure is already in place. Just as we first started hearing the early cries of the COVID pandemic in global markets, the US itself was nearing the tail end of a midstream build out to support rising crude flows from the Permian Basin. The completion of the Gray Oak pipeline, the EPIC pipeline, and the Cactus II pipeline in the first quarter of 2020 lifted throughput capacity by more than 2 million barrels per day to Corpus Christi alone. And then more recently, we saw the completion of the 1.5 million barrel per day Wink to Webster pipeline system from its Midland origin point, providing an additional outlet for Permian WTI to hit the export market. We expect that the commencement of services on this new line will translate into rising crude exports from the Houston area. But for now, Corpus Christi still remains the top hub for US crude exports, which primarily comprises light sweet grades from Texas. Corpus exported roughly 1.6 million barrels per day on average in 2021, more than doubling Houston's roughly 550,000 barrel per day figure. And I really want to highlight a smaller port hub as well. The Beaumont Nederland area came in as the third most active port area in 2021, encouraged by its connectivity to a wider variety of grades. Now, there are some tighter draft restrictions in this area that's discouraged some WTI export activity. And instead, we've seen that historically, the dominant grade from Beaumont Nederland has been Bakken light sweet crude. And you'll see that these flows kind of fell off the chart mid 2020 as parallel court cases in North Dakota surrounding the DAPL pipeline kind of created a lot of uncertainty around the future of these flows from DAPL to ETCOP and then to Beaumont and Nederland for export. But since then, we've seen these flows start to trickle higher, partially driven by higher Bakken production, partially driven by higher stakeholder confidence. But another thing that's driving these flows is Canadian deliveries to the US Gulf Coast. Heavy sour crude can flow from the Market Link pipeline to Nederland, where there's now more capacity for these additional exports. So more often we're seeing grades like WCS and Cold Lake loaded into cargoes around 500,000 barrels per day at Beaumont and Nederland, and then reverse lightered onto a VLCC for long haul shipments to Asia Pacific. And you can see that clearly in the data here. Canadian crude deliveries to the US Gulf Coast are at historical highs right now, and that's bleeding into the US export market as well. More than 135,000 barrels per day of heavy crude was exported in 2021, according to government statistics. And if you look at December alone, that's more than 220,000 barrels per day. Now, where's it going? We expect that the largest portion of these grades are going to Asia Pacific. In the fourth quarter alone, India was the top importer, taking about 115 to 120,000 barrels per day of heavy crude from the US Gulf Coast. We've seen participants like India increasing their intake of heavy sour grades as well as light sweets like WTI, and instead they're reducing their intakes of medium sour. So that would be Mars or Russian Urals. So that leaves us with the impression that both domestic and international refiners like India could be blending more heavies with sweets like WTI in order to meet an average medium sour spec required for their refineries. So to recap just a little bit, we do have higher production, but we also have rising demand. We have demand out of Asia Pacific and we have demand out of Europe. And it's increasing the call on US crude in global markets. In turn, that's lifting our benchmark prices. NYMEX WTI is at a rare premium to month 2 ICE Brent, which is the prompt contract used to price waterborne cargoes. And we're seeing FOB prices for WTI at the Gulf Coast rising to a record high against ice Brent. And this is particularly interesting. If you look at the chart on the left-hand side of your screen, you can see that the FOB relationship to ice Brent has moved into a direct correlation with the NYMEX spread 2-month to ice Brent. And this is a shift from where we first started seeing prices when exports happened in December 2015. Traditionally, the NYMEX spread 2-month to ice Brent would need to be around $2 to $4 per barrel in order for the arbitrage to be considered workable. But now with this increased demand and this higher call on US crude prices, that's moved from an inverse relationship to a direct correlation. So we're still seeing FOB prices trend higher despite already being at record highs, and the arbitrage still works. On the right-hand side of your screen, you can see that WTI delivered to Europe is already pricing at a discount to competing North Sea 40s. And then the arbitrage looks even more attractive for refiners in the Asia Pacific, with WTI at discounts as wide as $5 per barrel compared to competing grades out of West Africa like Bonnie Light.
Thank you, Amanda. And talking about short haul voyages such as those, shorter haul voyages, should I say, is a great segment into our freight part. So the freight market is a huge fan of US Gulf crude exports. And that is because it's one of the longest possible voyages for these tankers. And by keeping tankers employed for longer, it has the potential to lift rates globally. Now, this matters because the market has been oversupplied for a while in terms of total capacity. The Atlantic Basin specifically has been oversupplied. What we're seeing here is vessel availability basis US Gulf and Gulf of Mexico across the three sort of major crude tanker classes, which are VLCC, Suezmax, and Aframax tankers. And what we can see over the last 2 years is that available capacity has risen slowly but steadily by close to 50%. And that has had obviously a consequent impact on prices.
Hello, thanks, Arthur. So yes, indeed, the tanker market is oversupplied. Just to give you an idea of just how oversupplied it is, by the end of this year, the tanker fleet is expected to have grown by 7% compared to pre-pandemic levels. And then when you pair that with the fact that oil demand is roughly at pre-pandemic levels right now, not any higher certainly, then that really tells you a lot about why freight prices or freight rates are so low right now, which you can see on the chart there. As Arthur mentioned, you've got the main crude vessel classes from Aframaxes, Suezmaxes up to VLCCs right there, showing rates much below the peaks that we saw back in the wild days of 2020. And so how does the freight component look in terms of crude arbitrage? Well, we look at the share of freight in the delivered cost of a commodity by, and we call it the weight of freight. And freight's role in the delivered cost has really dropped significantly from 2020. And that's because of a combination of low or higher crude prices right now and much lower freight rates. So the weight of freight for US crude delivered into China on a VLCC has hovered sort of in the 2.5% to 4% range in the last year. And you compare that, so that's what's in the left chart right there, and you compare that with what's in the right chart, with some competing grades that could be delivered into China. And the weight of freight is still higher on the US to China trade route because, as Arthur said, it's halfway across the world. Naturally, the weight of freight is going to be a little bit higher. So when the freight market is depressed, one thing that does is it helps the arbitrage to ship barrels on long haul voyages such as US Gulf Coast to China. And another cost component as it relates to freight that we look at Argus is lightering and demurrage, as Amanda was talking about in the Gulf Coast. A lot of the infrastructure buildup is happening, but generally we're still seeing a lot of VLCCs load via reverse lightering because draft restrictions along the coast prevent VLCCs from loading the full 2 or 2.1 million barrels. So in Houston, we see full reverse lighterings. We assume 3 Aframaxes are used, and for that, and it's not particularly cheap. You have to pay to hire those Aframaxes, and then you also have to pay, if you're a charterer, demurrage for that VLCC to be waiting for those Aframaxes to come up and fill up the vessel. And then if you look at Corpus Christi, you can have partial direct loadings there. You'll see that actually that lump sum cost, and this is just sort of a snapshot from early February pricing. You can see the lump sum cost for U.S. Gulf of China is slightly higher, and that's because of port fees at Corpus Christi. But so you'll pay those port fees, but you're not going to have to pay for as much lightering, and you're not going to have to pay for as much demurrage loading there. And you can see a rough cost breakdown between taking crude out of those 2 different hubs in the U.S. Gulf Coast. And now, how have those discounts changed over time for loading on a VLCC at Corpus versus Houston? They've actually widened a little bit recently. It's not too significant. We're talking, ranging between 5 to 25 cents per barrel. But we have seen those widen, and that's because the Aframax market has tightened up a little bit in the Gulf Coast, just higher regional crude demand, and continued, and so that has tightened the Aframax market, which has put upward pressure on Aframax lightering costs.
Thank you, Nick. So let's look at what freight market dynamics look like for 2022. Now, on the demand side, ton miles is not necessarily the best measure, but it is a good proxy for the market. And what we can see here is we've compared monthly ton mile data for crude tankers out of PAD 3 to 2019 averages. And what we can see is, well, again, that steady increase that we're expecting since September of last year, really. But most importantly, that January 2022 figure is the highest on record in the last 2 years. So it clearly shows that drive, that demand for the light sweet grades which are coming out of the US. Again, it's a theme we're repeating throughout this webinar. The market is extremely tight, and any additional barrel that the market can get their hands on, they will. Now, the supply side, that's a very interesting story. As Nick mentioned previously, 2022 is going to be extremely busy, and that really has the potential to keep a lid on any improvement on rates. But there's a couple subtleties there to take into account. The first one is that red line that you see there are Argus scrap steel prices. They're at decades high right now, and it makes a lot more sense to start scrapping your tankers. And this chart, what it's missing is that surge in scrapping volume at the end of 2021. At the same time, that shadow fleet, which services Iranian and Venezuelan barrels, that sanctioned fleet, it really doesn't have the potential to grow further. And the reason is, as we mentioned, when looking at Iranian volumes, they've got potentially 200,000 barrels per day left in them. So that isn't going to be enough to absorb all that extra capacity, all those VLCCs and Suezmaxes and Aframaxes, which are now nearing the end of their useful life and should be scrapped. So that theme, which was allowing older tankers to survive and to remain in business in the last 2 years, won't be applicable anymore in 2022. So if we combine that with the surge in scrapping, which we assume will continue, maybe the picture isn't as dire as it looks. But most importantly, 2023 and 2024 is where it gets interesting. It's no secret that container ships, container companies. You're seeing in the news the record profits by Maersk, etc. Dry bulk carriers as well. They've enjoyed very good returns. So that has led to a flurry of orders, if not hundreds of orders actually, which has taken up all that capacity, all that shipbuilding capacity in shipyards in Asia. So owners right now, if they want a tanker, they're going to have to wait till 2025 for that to be delivered. So those numbers you're seeing there for 2023, 2024 in terms of deliveries simply won't be able to increase. It might even get delayed, bar any change in circumstances or cancelled orders, etc. I'm not going to pass on to Jay to talk about Argus forward curves and what lies in store going forward.
Oh, great. Thanks, Arthur. I'm going to talk mainly about forward prices as they relate to freight and crude, and I take a little look back and do some year-over-year comparisons. So the first slide, this graph shows the U.S. Gulf Coast to China monthly spot prices, average monthly spot prices for 2020 and 2021 in comparison with the current forward curve for 2022. It's a year-over-year comparison, January through December. As you can see, in early 2020, there was a 3 sigma event. That was COVID-19, which created a demand shock when the outbreak happened, which was exacerbated by the Saudis and the Russians flooding the market with excess crude oil. The event, of course, increased the demand for VLCC tankers by market participants to load cargoes, to transport crude, and to use as floating storage. But notice in the second half of 2020 and all of 2021, freight prices decreased to historic lows due to the decrease in crude demand. There was an increase also in the use of charter vessels, which also helped contribute to the lower freight prices. But if you take a look at the 2022 forward curve, the curve, as you get out to about May or June, starts sloping upward. It's in contango. As we're coming out of the pandemic, there's an increase in oil demand and the need for tankers. However, as Nick mentioned, the tanker supply is plentiful, and there is a larger fleet of tankers on the market, which is suppressing freight rates. So due to the oversupply tanker capacity, freight costs are lower than historical averages, even out on the forward curve. Now, the next slide, I've done a comparison here with the weight of freight, which Nick talked about, as well as the freight forward prices and I'm comparing the US Gulf Coast to China and the US Gulf Coast to the UK. If you look at the weight of freight, you notice that China is sloping upward, the route to China as well as the route to the UK. Some of that is due to the highly backwardated crude curve, WTI or WTI Houston. Pretty much all the crude grades are severely backwardated, which I'm going to talk about in the next slide. And then if you look to the right, you'll see that the US Gulf Coast to China freight cost is actually sloping upward. And I think Nick mentioned that as well, talking about how that is a longer haul and those prices are moving upward. Whereas the price to the UK from US Gulf Coast is really flat, I would say, overall going out 24 months. So due to the oversupply of tanker capacity, it looks like freight will continue to be fairly low, below historical averages anyway. So moving on to the next slide. So I'm going to talk about crude oil here. I like to look at WTI Houston and what have you, but I've pulled several grades: AGS, Mars, WTI Houston, WTI Midland. And if you notice, the curve is drastically backwardated. We do have some pretty bullish forecasts that came out by JP Morgan and Goldman Sachs. I think those were back in mid-November, forecasting 2023 that crude would hit as high, WTI would hit as high as 105, 125. But there's a lot of uncertainty in the market. Some of the uncertainty, of course, is around OPEC unwinding their production cuts, nuclear talks between the US and Iran, the Russian-Ukraine situation. So lots of uncertainty. The shape of the curve is driven by market fundamentals, supply and demand, especially on the front end of the curve. The relationship between supply and demand at any point in time can move the curve upward or downward. However, EIA came out with a recent forecast, I believe it was last week, and with the front end of the curve being so high due to tight supply and increased demand, rig counts have increased. So they're actually showing that WTI prices for 2020, 2022 will be around $79.35, whereas for 2023 they're showing $65, roughly $65 a barrel. So the EIA is much more in line with where the forward curve is right now. So if we go on to the next slide, I wanted to illustrate how backwardated the forward curve is. I use WTI Houston FOB. WTI Houston, as you know, is a very liquid grade. It's virtually setting the marginal price globally. The US Gulf Coast is pretty much indexed to WTI Houston. WTI Houston is part of the Maya crude formula now. It makes up about 65%. So I did a year-over-year comparison as of February 1st. I pulled the February 1st forward curve for 2021, starting March of 2022 through December 2025. And it's the orange line, and you can see it's very flat. And then the purple line that crosses the 2021 forward curve, you can see that that's the cumulative backwardation. And I took M1 minus M2 going forward 48 months. And you can see the backwardation last year on February 1st, going forward 48 months, ranged from 15 cents to $2.46. Now going up to the blue line, the 2022 line, that's the forward curve today for WTI Houston FOB. The other, I guess, light blue line sloping upward is the cumulative backwardation. So notice, as of February 1st, the backwardation for the current year forward curve is $1.25 to over $20. So highly backwardated, front end of the curve, tight supply, which is really pushed it up, but highly backwardated forward curve. So if we move on to the next slide, I believe this is my last slide. What I wanted to show you here is net forward prices. We have a lot of companies that are using our crude forward curves as well as our freight forward curves to come up with net forward pricing. They're using it for a competitive analysis. They're using it to determine what's the highest price market, where can I take my crude, as well as studying competitors, looking at where they're dropping crude in. A lot of these companies even stop at the water, but they want to know, where is freight, where is the origination export point, and where is it dropping in as it's being imported. All of the data I've used, by the way, is from our freight forward curves and our crude forward curves. You can check out our website if you have questions about those, or you can contact me directly. So with that, I want to turn it back to Arthur.
Thanks a lot, Jay.
Thank you.
So just to end with some key takeaways, both on crude and freight. On the crude side, so the US oil industry is quickly realizing that the market is evolving out of the COVID depression. Oil is needed, and there's ample capacity for exports out of PADD 3, with US crude exports positioned to grow to a new record high that could hit 3.5 million barrels per day in 2022. And this comes as OPEC plus crude exports growth comes to a halt. So it's very important to keep those two in mind concurrently. On the freight side, well, it's a simple equation. The further afield the market has to go to get those barrels, the better for tanker markets. And a boost in ton miles from increasing US Gulf loadings would really have the potential to boost Atlantic Basin freight rates in the first instance, but also lift earnings globally. You need 3 times the amount of VLCCs to lift equivalent volume out of the Middle East compared to the US Gulf. So it has massive potential. And even though overcapacity will remain an issue in 2022, we mentioned high scrap steel prices and limited room for the sanction trade to grow further, which could further help as well tanker prospects. Thank you so much for listening. We're now going to open up the floor for some questions. I see there was a few that came out in the chat. For the first one, I'm probably going to ask you, Nick, to come in. So how do Jones Act tanker rates compared to the US crude exports rates you showed? I'm considering the economics of crude movements from the US Gulf up to the US East Coast.
Sure. So the Jones Act market, that's the US domestic fleet. All shipments between US ports have to be conducted on Jones Act compliant vessels. It's a fairly small fleet, and because of a few reasons, including high new building costs, those freight rates can be very expensive. So we're seeing a shipment from Corpus to Delaware Bay up at around $4 per barrel. And that would be on an MR size tanker, a little bit over 300,000 barrels on that ship. And then you compare that with like a US Gulf to China VLCC shipment, which is a bit over $2 per barrel. So that just gives you an idea of sort of how much more expensive the Jones Act shipments are.
Thank you, Nick. Maybe Amanda, you can help us answer this one. How does the Capline reversal impact US crude exports?
Yes, that is a fun question. So the Capline reversal, so far, it's a very small initial volume, roughly 100,000 barrels per day to start off with. And we're seeing that the majority of that volume is heavy Canadian sour. So what we're expecting to happen is that more Canadian sours are going to be delivered into the Louisiana refinery market, and we'll see additional light sweets shipped to the St. James market by way of the Bayou Bridge pipeline and the Zydeco pipelines. We've already seen spot liquidity increase for both WTI and Bakken at St. James. And the higher light sweets are going to be blended with the Canadian deliveries down Capline to meet that medium sour spec. And this is going to result in more domestic sours like Mars and Poseidon being exported from the Louisiana offshore oil port. We already saw in the fourth quarter that Louisiana crude exports were roughly 320,000 barrels per day, with almost 80% of that going to Asia Pacific. And we know that that's our primary market for medium sours. So we expect that this trend is going to continue. And while we don't expect the delivered volume from Capline to directly hit the export market, it is going to push out some of the medium sours that typically stay in the Louisiana market. And then additionally, I just want to tack on to this statement is we also saw the closures of the Convent and Alliance refineries in Louisiana. So that's going to add to more Louisiana crude exports as well, as that's combined as throughput capacity of those two refineries is around 500,000 barrels per day. So it wouldn't be surprising to see Louisiana crude exports potentially double compared to what we've seen historically.
Thank you, Amanda. Maybe going back to you, Nick, there's a question on freight here. What's your view on the Suezmax market from the US Gulf Coast to Southeast Asia going forwards for Q2? And then there's a comment that follows. 2 years back, we heard a lot about development of SPM in US Gulf Coast being developed for loading VLCCs without reverse lighterage.
Sure. So on the Suezmax market, I guess a few things come to mind. First is one of the themes that we've talked about is that the tanker market is oversupplied. So I think it's helpful to see the tanker market as a global market, and also see sort of it not even being very segment specific. So even if you don't have so many Suezmax deliveries, you might still have, which you do in the next year, you might have a lot of VLCC deliveries, which will then in turn weigh on Suezmax demand. And you can look at the Aframax market in the same way, as well as Panamaxes and smaller sizes. So with Suezmaxes, one thing that comes to mind on the demand side is that West Africa is a major loading zone for Suezmaxes, and exports out of Angola and Nigeria are expected to continue to struggle. So that will be taking away what is traditionally one of the key demand points for Suezmaxes. So I expect Suezmax rates to remain pretty depressed for the rest of this year, and just like a lot of the other vessel classes. And then the second question was about getting rid of or infrastructure developments, removing the need for reverse lighterings for VLCCs in the Gulf Coast. Yeah, I know that there are a few projects in the works, and I would love to be able to give a very detailed view on when these are going to start up. But certainly a big goal of the industry is to make it so you don't have to do the expensive reverse lightering. But I can look into that and get back to whoever asked that question later.
Thank you, Nick. Maybe Jay, you can come in to answer these two. We've had a question about how many months forward do your dirty freight curves go, and whether you provide those for West Africa to UKC and China as well.
Yeah, oh, good question. Yeah, our freight curves, we actually launched clean freight last year, and we launched dirty freight last year. They extend forward 24 months. We do provide for dirty freight West Africa to the UK as well as to China. One thing about our forward curve products, we're always expanding markets. So if there's a market that you need, a lot of times we can add those markets, and we get a lot of market data for our forward curves. So they're highly assessed curves, if you would. So good question. Thank you for asking it.
Thank you, Jay. How does Japan fit into the picture of WTI is one of the questions we've had, if anyone wants to take that.
I would say that they are one of the takers of WTI, but overall, I don't think that Japan reflects a major drop in the bucket. I think that they take 1 or 2 cargoes per month, and a lot of that can be medium sours too. We see ANS going to Japan more often than WTI. Well, right on par with flows to WTI. But in terms of whether or not Japan demand will impact significantly the price for WTI in the spot market, I don't think so.
Thank you.
Mm-hmm.
I'm maybe going to take the last one just to round up. So what percentage of exports from US Gulf Coast would incur less freight to make the ARB work, meaning they have a fixed component in their freight cost and treat it as a sunk cost? Also, what does UKCM stand for? So UKCM refers to the UK continent and Mediterranean regions. So that's Northwest Europe and the Mediterranean, starting with the easy part. As for the other one, I guess it really pertains to which part of the freight is less expensive. Well, on the bigger vessels, yes, you do need the lightering element, but at the same time, you do get economies of scale by using a VLC or a Suezmax rather than multiple Aframaxes. So to this one, I'm going to say it depends really what you're loading, where you're loading it, and on what vessel class. I think we've now run out of time, but I can see there's still a lot of questions that we haven't answered. So we're going to collate those and divvy them up between us and reply by email. Just a reminder that in the next 24 hours, you're also going to get a copy of the slides as well as a recording of this session. If you'd like to know more about our data or request a demo of our platform through our website, please feel free to go ahead and do so. Otherwise, thank you very much for taking the time today. And thank you as well to my fellow panelists for joining.
Thanks for having us, Arthur.
Thanks, Arthur. Thanks for having us.
Cheers. Thank you, everyone.